Welcome to Talk Tickers, where we break down the earnings calls so you don't have to. Today, we are diving into a real head-scratcher from Foundry Bancorp's latest briefing. The company beat expectations, so why on earth did the stock drop? Let's get into it.
So yeah, this is the big question, right? It's one of those classic Wall Street puzzles. The numbers look good, the strategy they're laying out seems totally sound, and yet the market got spooked. Our job is to play detective and figure out exactly why.
All right, to get to the bottom of this, we've got to start where every analyst does, with the big headline numbers. Let's take a look at the beat, and of course, the drop.
And the beat here was pretty clean. Foundry posted a loss of 10 cents a share, which was actually better than the 11 to 12 cent loss the street was looking for. Revenue also squeaked by, coming in just ahead of the consensus. I mean, on paper, this is exactly what you want to see, a solid win.
And yet, this is what happened to the stock. It fell 1.36% on the day of the call. And get this, the trading volume was more than triple the recent average. So this wasn't just a quiet drift downward. Investors were actively hitting the sell button. So what's the deal? Why the major disconnect?
Okay, so if the headline numbers were actually good, the problem has to be hiding somewhere deeper. We need to pop the hood and look inside the bank's actual profit engine. For any bank, this is where the real story is always told.
And for a bank, that story always starts with net interest margin, or NIM for short. Just think of it as the bank's vital sign. It's the spread between what they earn on loans and what they have to pay out for deposits. A NIM that's growing is a very, very healthy sign.
And would you look at this? Foundry's NIM isn't just growing, it's actually accelerating. It jumped 12 basis points just from last quarter, hitting 2.28%. That's the third straight quarter of expansion. So the core business is getting healthier and more profitable. The plot thickens, right? If things are getting better, what's the problem?
So how'd they pull this off? Well, it was a classic 1-2 punch. First, they started earning more on their assets, making their loan book work harder. And second, they actually managed to pay less for their liabilities by bringing down the cost to their deposits. You put those two things together and bam, you get an 8.3% jump in net interest income from the last quarter. That's pretty powerful stuff.
Now, you don't get 3 straight quarters of NIM expansion by accident. This is all the result of a very deliberate plan, a strategic pivot that management has been calling balance sheet engineering. They are actively reshaping the bank, piece by piece, to get better returns.
And here's the playbook, plain and simple. First, they're remixing the loan book, out with the old lower-yielding stuff and in with new, more profitable commercial and consumer loans. Second, they're focused on growing core deposits, trying to build real relationships with customers. And third, they're using their capital to buy back their own stock while it's trading at a discount.
And you can see that strategy playing out right here. I mean, look at these numbers year to date. They've aggressively moved into commercial and consumer loans while they've been shrinking that multifamily portfolio. This is literally what balance sheet engineering looks like.
On top of all that, management is putting its money where its mouth is. This quote from the CEO, Jim Nessie, says it all. They're buying back their own shares for under $10 a pop when the actual tangible value of the assets is almost $15 per share. That's a huge signal of confidence, and it's a direct way to create value.
Okay, so let's recap. We've got a beat on earnings, the core business is getting healthier, and there's a clear strategy that seems to be working. So the mystery remains, why did the stock fall? Well, the answer, and this happens a lot, wasn't in the prepared remarks. It was hidden away in the question and answer session. So after hearing all this good news, the analysts on the call all started asking pretty much the same question, just in different ways. And that question was, this all sounds great, but when does the bank actually stop losing money and start making a real, sustainable profit? You see, for the market, timing is everything. And here it is. This is the answer that spooked the market. Management said that for the rest of 2025, any margin improvement is going to be limited. Why? Because the real prize, this $75 million chunk of old low-rate loans, well, that doesn't get repriced higher until sometime in 2026.
And that, right there, solves our mystery. The market saw the headline beat, it understood the strategy, but then it heard that the big payoff is still more than a year away. All the good news got overshadowed by a delayed timeline. Investors are basically saying, great plan, show us the actual profits, and then we'll get excited. It's a classic wait and see.
So with that timeline now crystal clear, what does it all mean for the stock going forward? Let's get to it. Here's our official verdict and what we'll be watching for on the next earnings call.
For Q3, we're forecasting another small step in the right direction, probably a loss of around 9 cents a share. Since that big catalyst is still way out there, we expect the stock to just stay stuck in a range. The two key things to watch are simple. We need to see that net interest margin keep ticking up, and we need to see them keep growing those core deposits. Any slip up there would be a big red flag.
So our final rating is market perform, and really, this reflects a classic tug of war. On one side, you have a management team that is absolutely executing a smart, disciplined turnaround plan. But on the other side, you've got a timeline to real profitability that is just longer than Wall Street wants to wait. The strategy is solid, but you're going to need patience.
And of course, we have to end with our usual reminder. This has been an analytical breakdown for you, but it is not financial advice.